Hello, and wow, what a week with earnings we had. And here now, just a kind of summary in what I did so far on Spot, Verizon, Google, Microsoft, Meta, and Intel. Okay, have fun. You will check the next slides. You will see that I have done more or less non-directional trades in a way that I don't really expect a kind of up and down. I just create a kind of iron condor or short strangle in just expecting that the stock will keep in a certain level or certain range, which you will see that it's not always the case. So let's go ahead. The first one I did is Spotify Spot, and as you can see, the opening here on the day after the earnings was 150 compared to 164.18 the day before. So you see there's already a very nice movement of almost 10%. So what I did is an iron condor the day before. As you see here, I have 145, 177.5. That was my expectation. So you can imagine when it opened at 150, obvious that the put has a value because this is nice when it's 145 on the July 28, but that was on July 25. So as you can see, I sold at 0.77 and I had to buy the put option at 0.55 because as you have maybe seen, Spotify went even lower up to I think even below 140, but just to see that the profit was small, but at least it was a profit because the movement was out of the range as I expected. Then on the same day, I went into Verizon, as you have seen here. Well, this one works quite well because you can see I did a range of 32.5 to 35.5 here, and the stock closed at 34 and opened at 34.66, which was perfect because as you have seen here, I get 0.29, and then I just had to close marginally. Okay, you may say I would not even need to close it. Okay, here I close at 0.09 because stock went maybe even to 35, so I want to be on the good side that I would not be exercised on the call. But overall, it was a perfect trade. Today, I did an iron condor on Google, and Google, as you have seen, I have here again a very beautiful range from 116 to 131. Wow, the stock went up to 130. So you can imagine what happened to this 131 call. This one was, I would say, not this 34 or 24. It was even up to 50 or 60. So yeah, it was not so easy, but fortunately the stock came down. It didn't stay long at 130. It came down maybe to 129. And you see here again, the profit was quite small. As you see, I sold at 34 and I bought at 24, 34, 24 because I did three on each side. Well, as I said, this is when the stock goes out of the range, and here I can say you that it goes so fast that you should be just saying to yourself, okay, never mind, just flatten out and go out of this transaction as soon as possible. Iron Condor of Microsoft was smoother, I would say, because the earnings were below expectations. So I did here a kind of Iron Condor, but I did it in two transactions. I did a vertical call spread and I did a vertical put spread because for any reason I could not get executed on the Iron Condor. It was about, as you can see here, just 5 minutes ahead of the closing, and here 7 minutes ahead of the closing. This is Swiss time, 10 p.m., so it's about 4 p.m. in New York time. So for any reason, I had to do it just by two transactions, and I get both 0.44 because the stock was here around 350. So it was perfect, 372, 327.5, and the stock is below expectation, so it came about 341 or 338. And you see even here when it was 338, I mean it went really down from 41 to 38. I be on the safe side and say to myself, okay, let's cover the put side at 0.31, but the call side obviously I would not have to close it, but I did it. But at the end it gives a nice profit. This 0.88 minus the debit, I just get 52. Keep in mind that I always have to pay $4 for the for each option, a dollar per option. So that one was fine. Actually, I have tried beside an iron condor a short strangle. Why? It's because the volatility was so high in a way that I can really put a short strangle with a very, very low delta, meaning that it was even paid so well. You can see here on this transaction, I get $1 for each side. I mean 50 cents more or less for each side for a 250 put and a 360 call. I mean, this is incredible when the stock is around 300, as you can see here. So I had a downside of $50 and an upside of $60. Already shows you that actually the upside was even better covered than the expectation. We call it a kind of skew. That means the call side was more expensive than the put side because the market expected that Meta will have really good results. So I was covered between 250 to 360 and I still get a dollar credit. So obviously this is a big risk because it could maybe go to 400 or it could go down to 200. But seeing that I get such a nice premium out of it, I did that, and at the same time I did again a kind of iron condor, as you can see here, which is 270 to 332. So here my risk is $250, the difference here, and I get about 83, which is nice out of 250. So it's about a 20-25%, which is the normal width when you do an iron condor. So that's very nice because you see even I had to cover the call side of the iron condor here at 50 because you see it went up to 325. It was even pre-market at 330. So I said to myself, my God, now it will be really hard here to cover. So at the end I covered 0.5, which was a bit higher than let's say what I bought here. But since the call side, sorry, the put side was worthless. So then I say to myself, never mind if I pay here a bit more because I got collect over 83 and I cover here at 50. So overall, with the short strangle, I get 1.23 profit with a $6 commission because it's an iron condor plus a short strangle. Then seeing the success I had, let's say in the short strangle, why not doing on Intel? It was of just yesterday, and that one was really perfect in a way that you see with the with the short strangle, I have again the possibility to have a range of 30.5 to 39.5. So when you have here the closing at 34,355, I had a $4 downside protection and a $5 upside with the same delta. That means again the expectation was in the market that the price will be higher. So I said to myself, okay, I will play with it, and I do this range of let's say $9, which was 9. So again $5 up, $4 down, and the price open actually, it was long about pre-market 37 and a half, but actually it opens 36.79, which is perfect because of all these transactions, both call and put were 0.1, but on the safe side, I even cover it at 0.09 to 39 and a half, which probably would not be necessary. But commission wise, I pay only here these $6 and I don't pay when I close the position. Strategies on earning expectation. I think it's always important that you look back what could be improved, what could be better, and this is something I really look into it. First of all, what strategy you should choose. I mean, I have chosen now it is so-called non-directional. That means I expect a kind of sideways or a little bit up, a little bit down, but not out of this range. That's why I choose the iron condor on the safe side, that I know how much I can lose as a maximum, and the short strangle as a kind of really speculative. But if you like a directional trade, that means you would just do one side because you expect, let's say you expect better earnings, and then you go on the put side, or vice versa. This is okay too. I just say with these earnings is a kind of luck really, that you have sometimes he goes up and sometimes go down. Always check the IVR of the stock, as I did a video before. IVR is so important, implied volatility ranking. Usually it's already high when earnings come up, so really look at it and check it. It should be higher about than 20. The delta of your option. I think if you trade this kind of non-directional iron condor, it happens sometimes that you got a higher delta on one side. Like I had this higher delta on Meta and on Intel, because the expectation was already that the price probably will be higher. So this is interesting that you can go for a zero delta and actually even get more premium on one side, let's say the call or the put side. Or you just say to yourself, I want a bit more space, I mean more security, like I had this with Meta. So I think this is important, that you go for a zero delta, or let's say that you have an equal delta on the call and put side. Then this is already what I recommended in my last video. Always trade about 30 to 45 minutes before the closing. Really, this is the best, because then you get a kind of closing price of the stock, because the next day, obviously the aftermarket, pre-market is always based on the closing day. So the earlier, the better. But as I said, this example with Microsoft I had, I really tried to do an iron condor, maybe a quarter to 10. It didn't work out, so I had to do vertical strategies, which I just did 5 minutes before and 3 minutes before closing. Then, really important, this last point on earnings day, try to close the position as soon as possible. This is really, really important. I mean, if the market opens, you have to wait about 5 to 10 minutes till the spread of the options will give you, let's say, a good pricing, bid and ask pricing. It's not that you can right away trade 1 minute after opening it. You have to take about 5 to 10 minutes that the spread, the bid and ask. But then I would say within 15 to 20 minutes after opening, you should close the position and not actually wait that maybe the price could go a bit up and down, whatever. You know, the price is moving so fast, it makes really no sense that you wait and hope maybe to get a bit narrow or let's say a better price. Frankly speaking, is that if it touches really one of your limits, I mean on the up or down side, then you just close it and say to yourself, okay, never mind. I mean, maybe you have a break even. There are so many other trading possibilities, so you just close the position and say to yourself, okay, it was not within my expected range. That's what you should do right away. These option strategies on earnings, you have seen that there are more coming up. I think next week is Amazon. But you see that it's not everything so smooth. It's really that you need to watch it out and to choose the correct strategy that you can really get a profit out of these earnings. Someone would say it's easier to do it because the earnings were so great, but on the other hand, it's not a question of how much. I mean, the question is not how much the stock is moving up and down. It's more the question if you have the range in it. Obviously, if you do a directional trade and then it goes to the other side, well, then you have your loss. But the point is more, in a non-directional trade, it's very important that you adjust more or less really the range you expect the stock to open the next day. Okay, any question or suggestion, just go ahead. I can do any strategy, whatever, of any earnings, so it's no problem. I would take a look and you can tell me what what you would prefer as a strategy. That's all. I hope you have enjoyed it. Until next time. Bye bye.